Adonis on this edition of A Cup of Joe with the Adonis Agency. And as promised, we're going to talk about insurance again. Last week we talked about term insurance. Today I wanted to talk to you guys about universal life insurance. So term insurance, as we talked last week, is temporary insurance. Universal life insurance is the start of our permanent insurance policies. So universal life insurance, what's awesome about this type of product is that it comes with flexible premiums and it comes with a death benefit that's pretty much guaranteed for life, right? So flexible premiums where in the beginning of it, you could put more money into the policy that actually accumulates in cash value that you could later borrow against. I don't recommend necessarily borrowing against a universal life policy because it's a little bit different from a whole life, from a traditional whole life. How the universal life policy works, I consider it to be term for life. Very similar to term insurance. After a while, the cost of insurance goes up, which means that, yes, the universal life policy, you're earning cash value, but as the cost of insurance goes up, a lot of the premiums that you're paying in the later years goes to just cover the cost of insurance. And eventually what ends up happening is that the cash value that you've accumulated also goes to cover the cost of insurance. So let me try to elaborate that a little bit more. When you first get the insurance policy, let's just say you're paying $100 a month, right? Maybe $40 is going to cover the actual cost of insurance, and $60 is going towards your fixed account, which is actually going to grow in cash value. Now, around year 10, that same $100 a month you're paying, now perhaps $90 is actually going to cover the cost of insurance, and only $10 is going towards building actual cash value. Now, in year 20, believe it or not, or year 30, and this is just hypotheticals, what ends up happening is the cost to insure you now costs $110, right? So what eventually starts happening, the cash value that you've accumulated over those 10, 20, 30 years, that cash value starts to supplement the premiums that you're paying to cover the cost of insurance. So that's what guarantees the insurance for life, right? Now, the ideal candidate for this type of policy, a fairly young or middle-aged individual that's not concerned about cash value accumulation, that's not concerned about borrowing from the cash value, someone who wants the insurance at the best possible cost for their entire life, where you're not going to have the high premiums as the whole life, but you're not going to have the market insecurities or the market fluctuations as the variable universal life, which we will talk about in our next edition. As always, whenever you're borrowing against a cash value, the great thing is when you're borrowing against a cash value in an insurance policy, there's no tax liability that you're responsible for. But as always, speak to your tax advisor on that and speak to your trusted advisor on whether a universal life policy is a good fit for you. If all else fails, please feel free to give my agency a call, the Adonis Agency, 631-390-8568. And thank you for joining us for this Cup of Joe. Have a great day.